Hi, good evening. Thanks for joining. Let's wait for a few minutes and give others time to join. We'll start shortly around 6. Thank you. Hi, Amit. Amit, your line is unmuted. Did you have a question?
Hi, Pratik, can you hear me?
Hi Girish, the webinar is live. We have participants who have joined us, and we'll start in another 5 minutes.
Sure.
A very good evening to everyone. Hope you're all safe, healthy, and are doing well. Like we started off by saying that knowledge is like money. To be of value, it must circulate, and in circulating, it can increase in quantity and hopefully in value. With that theme, I welcome you to the third of our webinars, this time on CARO 2020. For those of you who are joining us for the first time, a quick introduction, a quick background about us. We are here after having spent over a decade in financial reporting, auditing, and advisory. We want this to be a knowledge sharing platform. We have lots to learn from you, from your experiences, and we have as much to share. So this is actually a part of a series of update sessions or webinars that we conduct. This is the third of the webinar that we have conducted since we went live in July this year. And we hope to continue to keep sharing knowledge and learning. The topic that we have for today is a very contemporary topic. It is a two-part session, two-part webinar that we are going to have. The topic is on CARO 2020. Friends, the year-end audit is just around the corner, and CARO 2020 is going to be a major exercise for this year's audit. Originally meant to be implemented for March 2020, but given the time that the guidance note came, the pandemic came, it was decided that it would be made effective from the current year end. And the theme that we have for this CARO webinar is that a stitch in time saves 9. And I'll demonstrate to you why that saying is very, very apt in the case of CARO 2020. To give you a quick headline about what is CARO 2020 and why we are all here. The whole objective of CARO 2020 is to help facilitate and strengthen the entire corporate governance framework and improve the overall quality of reporting by auditors. In the current market scenario, in the wake of the recent corporate frauds, the MCA has tried to put a lot more responsibility on auditors in dealing with these matters. As you will see, CARO 2020 is no longer for the finance teams and the secretarial teams. There is role for people from treasury. There is contribution that one will expect from the ethics counselor, the ethics team. If you are a lender, this is a great opportunity for you to start reading the financial statements of your borrowers. The audit report earlier was criticized to be a very boilerplate audit report, not giving a lot of information. That has changed. With the advent of key audit matters, auditors now report a lot more about the qualitative aspects of auditing. CARO 2020 takes it one step further. In terms of what has changed in CARO 2020, the biggest change is, or to give you a headline summary of what changes have happened, the first thing that has changed is CARO 2020 has now extended its scope to consolidated financial statements. Earlier, CARO 2020 or CARO 2016 reporting was only restricted to the standalone financial statements. CARO 2020 now makes it mandatory for consolidated financial statements as well. And from a consolidated financial statement standpoint, what is relevant is that the principal auditor or the auditor of the holding company now needs to bring in their consolidated audit report on CARO the qualifications or adverse matters that have been listed out by the auditors of the components. A quick point to be kept in mind is auditors of subsidiaries, associates, joint ventures, all of these are within scope when it comes to accounting or reporting on the component exceptions. Two important and interesting items to be kept in mind from a guidance note standpoint. The first one is that what is material in the context of the consolidated financial statements is a part of the principal auditor's judgment. That is to say that if the principal auditor comes across an exception in their audit procedures, whether that is material and reportable under CARO 2020 is a matter of their professional judgment. However, if the component auditor has flagged off something as material and has flagged off something as an adverse item, that judgment cannot be questioned by the principal auditor. So very important for principal auditors, for holding companies, that when the group audit instructions or the group instructions are rolled out, these aspects are taken care of. One will likely to see statutory auditors at a consolidated level spending a lot more time discussing some of these findings with the auditors of the components. CARO 2020 brings about three kind of changes, to be very broadly put. First, it introduces new clauses. The second thing it does is it enhances the scope of existing clauses. And finally, there is one clause which was more of a repetition, has been taken off from CARO 2020. And as I said, that there is a lot of guidance available in the ICAI guidance note. The ICAI guidance note on CARO reporting runs into 200 pages, and it is clause-wise guidance. If you are an auditor, please make sure you follow it. If you are management, this is what your auditor is going to follow. Start preparing. And at the end of the day, remember, the devil is in the detail. Once again, when we talk about some of the guidance in the ICAI guidance, I'll highlight to you why the devil is in the detail. You read the clause, that alone may not be sufficient for you in complying with CARO 2020. What are the common challenges we thought companies would face? And maybe it is still worth spending another 2 or 3 minutes on this before we delve deeper into the actual technical issues. In our mind, there are 6 items that one would expect to face as part of challenges when implementing CARO 2020. This slide is not hard to imagine. 200 pages of guidance. For your reference, CARO 2016 had 8 subclauses. CARO 2020 has close to 40 subclauses. So you are clearly looking at a lot more data that the auditor will start to audit. At the end of the day, all of this is management's responsibility. The auditor will expect the management to try and keep the data available, to keep the items for auditing handy. This is not something that the finance team alone can do. A lot of coordination will be required internally with the audit teams. There are a lot of multiple stakeholders involved. And finally, there are quite a few nuances, quite a few finer points that are there in the ICAI guidance note, which really makes it imperative to start working on CARO right away. If you are associated with financial services, it is the right time to probably start engaging with your auditors. Clauses related to reporting on loans and advances are having an industry-wide impact. Some of those items are very, very difficult for management to provide, and therefore equally more challenging for an auditor to audit. So therefore, keeping in mind with our theme, 200 pages of guidance, 40 subclauses, and we are in mid-December already. So this stitch in time is surely going to save you 9. We are not going to talk to you about each and every clause in CARO. What we have tried to do is to try to give you a thematic view of how CARO 2020 looks like. We are trying to avoid the language in the order verbatim. We are trying to summarize it for you. We are trying to make it simpler. In our mind, there are 5 critical themes or buckets in which the entire CARO 2020 can be bucketed. The first one deals with non-financial assets. Here, the items that are covered are clauses on reporting of fixed assets or property, plant and equipment, intangible assets, right of use assets, investment property, and non-current assets held for sale. If you move on to the other bucket of clauses, they are the clauses that are related to loans and investments. You will see here how the scope of reporting has been significantly enhanced. The third bucket that we have to cover is the guidance around, or the clauses around, the clauses related to governance. There are several clauses in CARO 2020 that deal with compliance with specific laws and regulations. So for example, compliance with section 185, 186, deposit acceptance rules. We'll try and cover those relevant clauses here as part of the governance related theme. What we will do in the part 2 of this webinar next week is cover clauses related to borrowing and capital raising. And finally, we will talk about audit and audit related clauses. As you can see from this slide, not only does CARO 2020 talk about or require an auditor to work on the sources of fund and fundraising in terms of utilization of funds, deployment of funds, funds raised from a short-term basis used for long-term purposes and vice versa. It talks about the deployment in assets as well. And it covers both the financial and non-financial assets. It covers regulatory compliance. It covers audit related items, fraud reporting, and the like. So this effectively has a very good breadth of the operations of an entity. And that's why it's a massive change that needs a lot of focused attention and timely attention. So without spending too much of time on the background, let me straight away go into the first theme, the theme around non-financial assets. As I clarified a minute back, this theme will talk about the guidance that relates to property, plant and equipment, intangible assets, right of use, inventories, and the kind. To quickly talk about what is the requirement under CARO 2020 and what we believe are the points you should take back at the end of this discussion. The first requirement that one sees for CARO for property, plant and equipment and intangible assets is that proper records and full particulars of PPE and intangible assets need to be kept. Now, this is not very different from what you would have seen in the erstwhile CARO. What I would like to highlight here is that the term proper records is not defined in the guidance note. Generally, what is expected is the description of the asset, the location of the asset, the quantity, the date when it's put to use, if there is revaluation or impairment. Interestingly, the guidance note acknowledges that for companies that have been in existence for a long period, for a practical situation where, say, a company purchases 50 laptops in a single invoice, there could be practical issues around how do you allocate the cost to each of these items. What do you do if you do not know the date when an item is disposed of or sold? The guidance note does permit reasonable assumptions to be made in setting up of your fixed asset register. As an auditor, you would normally go and audit the fixed asset register. If you are management, please keep the fixed asset register handy and please look at whether some of these items that we just spoke of are covered in your FAR. The other item that CARO 2020 requires is a reasonableness of the frequency of verification of these assets and the accounting for discrepancies, if any. This clause requires management to physically verify inventories at a reasonable interval. The auditor needs to comment on whether the verification has happened during the year, whether all assets are verified at least once in 3 years, if not annually, and finally, if the verification results into discrepancies between the books and the physical assets that are there, whether those discrepancies have been dealt with appropriately. The guidance note once again does provide some bit of practical implementation support. It says you could have industries where it is not physically possible to check an asset. If you have a continuous process plant, which is housed within a larger plant, you could go back and fall back on indirect evidence of testing. This indirect evidence of testing could be something like, if my plant or an oil refinery, for example, is functioning at normal levels of efficiency, that is sufficient evidence to state that the smaller component or the asset is working properly. Because if that was impaired, if that did not exist, the business operations would have shown an exception. So key takeaway from the point of view of verification is reasonable intervals, verification should have happened during the year. If on account of COVID, the verification of assets has not been possible in the current year, the auditor may end up highlighting that during the year the assets may not have been verified, but once in 3 years the management ensures all assets are verified. So that is more about reasonableness and frequency of verification of fixed assets. The third item, and this is a new item introduced in CARO 2020, is that the auditor is now required to comment on whether the title deeds of all the immovable properties held by the company are in the company's name. Friends, this is a very interesting requirement for two reasons. First, this applies only to immovable property that is held as PP&E. So if you have a real estate company for whom immovable property is inventory, reporting under this clause does not trigger. Also importantly, the guidance note very clearly states that, or CARO 2020 very clearly states that this does not apply to assets that are leased. So if the company is a lessee and has taken an immovable property on lease, then the reporting under this clause is not applicable. And this is an example where I will show you why the devil is in the detail. If I move on, the other requirements with respect to property, plant and equipment is that if there is a revaluation of fixed assets or PP&E or intangible assets, the auditor needs to comment on whether a registered valuer has performed the valuation, and in cases where the change between the carrying value and the revalued amount is more than 10%, it could be an increase or it could be a decrease. This is something that the auditor needs to report on. And a very interesting point that comes out of this is that internal valuation specialists, it appears, are not acceptable when it comes to revaluation of PP&E. So take for example that you are a housing finance company, you have qualified valuers on your payroll because they need to assess the value of property that is considered as a collateral while giving a home loan. They are absolutely capable and competent to do a valuation of assets, of the property, plant and equipment of the company as well. But the clause and the guidance note together seem to suggest that one would need an external valuer or registered valuer under the Companies Act to be actually able to do this. And the last clause which has now been introduced, and which is again a new clause, is that there needs to be a factual statement as to whether any proceeding has been initiated against the company under the Benami Property Transactions Act, and if adequate disclosures for the same have been made in the financial statements. So from the standpoint of property, plant and equipment and intangible assets, these are the 5 clauses that are relevant. Our takeaway from these 5 clauses, or the point where you need to be mindful of, is the devil is in the detail. The clause heading talks of property, plant and equipment, but if one goes to the guidance note, investment property, right of use asset, assets held for sale are also covered. So please keep in mind that providing the auditors with your fixed asset register alone may not be sufficient. You may expect to see the auditor come and question, what about assets held for sale? Once again, if you are an NBFC which has repossessed assets like property and has shown them as held for sale, you could expect the auditor to come and quiz you on some of these aspects that we just spoke of. And this is again a bit of an item that requires discussion with the audit teams upfront. Item number 3 on title deeds, as you see on the slide, says leased assets are excluded. But if one had to go through the guidance note and look at the audit procedures therein, one would actually end up seeing that the auditor says, or the guidance note states, Although the auditor is not specifically required to test leased assets, there is no direct responsibility cast on the auditors with respect to leased assets. It is expected that the auditor will check if these lease agreements are executed in the company's name or not. And if there are exceptions, it is prudent to include this in the auditor's report. Now, this is a classic case of not having read the guidance note, and the auditor then coming in April, 2 weeks before the audit committee, and saying, by the way, I need to test these ROU agreements as well. So our suggestion here, our takeaway from this is, look at the fine print in the guidance note. If you identify items like these, which needs an upfront planning and a discussion with the auditors, the time to do it is now. Clauses around revaluation of assets, a greater level of challenge by the auditors. The auditor will now no longer take valuations at face value. In the current environment, they could very well go ahead and look at what is the competence of the valuer, who is the registered valuer, what is the methodology used, what is the technique used. But if you have a revaluation model for fixed assets, you should anyway be used to seeing this kind of test in the measurement related aspects. Finally, an interesting point to keep in mind is what happens if there is an immovable property not held in the name of the company, or the title deed is not in the name of the company. Would it automatically be considered to be Benami property and therefore trigger reporting under clause 5? Our analysis is, if one had to read the guidance note, the answer is no. The guidance note only requires a very factual assessment or a statement. It says if a proceeding has been initiated, that is the only time you need to trigger a reporting requirement. So that's a bit of an interesting take from the items related to PP and E, inventories, and intangible assets. Moving on, the other non-financial asset, so to speak, that we wanted to talk about was inventories. 3 key themes emerge from the clauses on inventories. The primary requirement for the auditors to comment with respect to inventories is threefold. First, whether the management has conducted physical verification of inventories at reasonable intervals, whether the coverage and the procedure for such verification by management is appropriate. Finally, if there are discrepancies which are greater than 10% at each class of inventory, whether they have been appropriately dealt with in the books of accounts. What an auditor would expect here is that at the end of the day, verification of inventory is the responsibility of the management. It is not the auditor's responsibility to verify inventory. It's that of the management. The management's responsibility is typically discharged by issuing instructions to staff, instructing external vendors, instructing counterparties to send confirmations. So the auditor will in reality check whether these basic steps have happened or not. Some of these items can also be checked when the auditor participates in the physical verification process. What are the steps that management has taken to verify inventory? The other important piece is that the physical verification and the books or the inventory as per books, if they are different by more than 10%, then they trigger an assessment or a reporting requirement. In the older versions of CARO, this was one of the clauses that the auditor had to report. But at that time, the auditor always went by the principles of materiality. So to give you an example, let me suppose I have packing material and the books suggest that the packing material quantity or value should be 100, but the value of packing material that is actually found in physical count is 90. Now, If packing material is, let us say, 0.5% of total inventory, the auditor would never report it because they would look at materiality on an overall basis. In CARO 2020, the materiality is at a class of asset level. And when one talks of class of assets in respect of inventories, some of these commonly known classes under Ind AS 2 or AS 2 are class of assets such as merchandise, finished goods, work in progress, and so on. If you have goods in transit should form a part of the respective class to which that inventory belongs. There are a few questions that I am seeing on the chat box. We will reply to each of them. If we can't reply right away, we will take those questions back and come back to you when we meet next. So this is the entire piece around verification of inventory and management's discharge of the responsibilities around the procedures for physical verification of inventory. One very new and interesting reporting requirement that has come up is managements will now have to reconcile the quarterly information that they submit to lenders with what is there in the books of accounts. Another very relevant requirement in the current environment, it is very common observation of those who have been involved in bank audits or banking industry, is that there are many borrowers who look to inflate debtors and stock and thereby look to have a greater limit for their working capital borrowing. And that's a correction that that the auditors will now have to test. So a very important data point, if you are a credit officer reviewing financial statements of borrowers, what this clause requires is, the gating question is, if at any time during the year, the company has been sanctioned a limit of more than 5 crores in aggregate by banks and financial institutions, then the reporting requirement under this clause triggers. And sanction includes renewal of limits as well. Fund-based limits, non-fund-based limits, both of them are considered in the threshold for 5 crores. So if there is a working capital facility against or on the basis of current assets that has been obtained by the company, then this reporting is triggered. So if somebody placed a charge on fixed assets and got a facility of 10 crores and did not have any other loan facility, reporting under this clause would not trigger. Now let's assume that this entity has indeed taken or has indeed got a sanction of more than 5 crores against stock and receivables. What CARO 2020 requires the auditor to now do is say, you would have at a periodic interval reported your data to the bank. As the auditor, we want you to go back and reconcile whether the information submitted to the lenders was in agreement with the books of accounts. So if as a company, your company submits stock statements, statements of receivables, aging of receivables, it is actually expected that for all the quarter end months, the auditor will come and ask you to show how the numbers compare to the trial balance. The auditor is not expected to audit quarterly numbers. They will just simply come and state, please show me your trial balance. I would like to see the number of inventory that you have over there. And I would like to see the statement you sent to the bank. If there is a difference, then a reconciliation needs to be prepared. And if the auditor is not satisfied with the explanations, this is an item that will get reported. That management had inventory of X, but the amount reported to the banks was X plus 20. And now it is for the reader, therefore, to understand, and for the lender, therefore, to understand in more detail why happened or what happened that this difference was created. So very relevant data point if you are a lender, if you are evaluating a company. The key takeaways that we have from this is a lot of commentary from auditors will now come on unaudited books of accounts. The auditor will look at your trial balance, which is unaudited, and look at stock statements. If there is a practice of sending monthly returns, the auditor will disregard monthly returns and only look at the months at the end of the quarter. So it's June, September, December, March that the auditor is interested in. So a very important and a new kind of a requirement that has been triggered by CARO 2020. Auditors will comment on reasonableness of how management believes the verification should happen. 10% threshold for discrepancies is on a net basis and for each class of inventory. And as I mentioned, the definition of materiality is very different. The materiality threshold is 10% and at a class level. So this is what we had to cover in terms of inventories and non-financial assets. Once again, this is an area where one should start work at the earliest, look at what stock statements have gone, look at what is there in the trial balance. This is probably also something that could call into question how updated the company's IFC procedures and policies are. So for example, one would then start to expect that the data that goes to a bank undergoes a certain internal financial control process to validate that the data that is going is accurate and reliable. With that, let's move on to the next theme. And the next theme that we have is around financial assets. This is for loans and investments. This theme should be of particular interest for those in NBFCs and HFCs. One of the items, a couple of items in this clause would actually require you to really look at this at an industry level. It will move just beyond your company, but it's an industry-wide issue that you are now going to stare at. So what are those kind of changes that have happened? The loans and investments actually has 6 specific sub-clauses for reporting. The first sub-clause for reporting requires quantitative disclosures of loans guarantees given during the year together with the amount outstanding. And I will highlight to you what has changed between CARO 2016 and CARO 2020 as we look at the subsequent slides. All I'm trying to introduce to you on this slide is what are all the 6 sub-clauses that deal with reporting on loans. The other item which also should be familiar is the auditor will comment on whether the terms of loans and advances in the nature of loans are prejudicial to the interests of the company. Again, a clause which by itself is not new. This did exist in CARO 2016 as well. The third clause, which again should be familiar, is the auditor will comment on regularity in payment of principal and interest where these terms have been stipulated. If there is a loan or an advance in the nature of a loan where principal and interest repayments is not stipulated, that automatically becomes a reportable item. The next item is if there are total amounts that are overdue for more than 90 days, then whether reasonable steps have been taken for recovery or not. Now you will come back to me and tell me that items 1 to 4 were already in existence in CARO 2016. But the biggest difference is CARO 2016 dealt with these in the context of loans given to parties covered under Section 189, entities in which directors are interested or related parties, to put it broadly. But CARO 2020 takes that rider away. It talks about all loans, and that, as you can now imagine, just completely changes the dimension or the landscape you are looking at. Imagine yourself as a large NBFC having lakhs of customers and an auditor having to comment on the regularity in payment of principal and interest, having to comment on amounts that are overdue for more than 90 days. This is going to be a gigantic effort, both from the point of view of management and auditors. And this is something which really needs urgent attention at an industry level. The best thing to do would be probably through industry associations, reach out to the regulators, ICAI, and seek more guidance. And we will look at why it's such a big change that we are talking of. The two other new clauses that have been introduced include commenting on evergreening of loans. Those of you who have been familiar with the financial services industries will know evergreening of loans is an audit focus area throughout. Effectively, what it means is whether an entity has given a fresh loan or has renewed a loan to meet the obligations or loans that were falling due for the same borrower. This is an area of great audit focus for auditors of banks and NBFCs. This clause is now required to be commented upon across companies. So if, let us say, company A, who is in the trading business, has given a loan to another entity which is falling due in the current year, if the client or company renews that loan or gives a fresh loan to repay the existing loan, that will trigger reporting under this clause. So a very onerous requirement on the part of auditors. Evergreening is extremely hard to identify. It needs a very high level of skepticism on the part of auditors. Finally, the auditor will need to report on the percentage of loans and the amount of loans to related parties and promoter groups. And this is reporting again where the repayment term is not stipulated or if the loan is repayable on demand. So 6 clauses that deal with reporting for loans. I'll talk about each of them in a little more detail. The first 4 clauses sound similar, but the scope has been significantly enhanced. From related parties, it now goes on to all loans. Now, if you are an NBFC and you are worrying about how you will deal with this, there is slight respite. The respite is only slight because the NBFCs have an exception from reporting on evergreening of loans and from giving quantitative disclosures of all the loans and guarantees given during the year with the amount outstanding. Because otherwise the entire loan book register of a company would feature in the auditor's report. But that's not the intention. So if you are an NBFC, items 1 and 5 out of those 6 clauses do not apply. The rest of the items are applicable to an NBFC. Now what we will do is talk about each of these 6 and see what are the specific takeaways that we want to share with you. The first one around quantitative disclosure of loans and guarantees. As I mentioned in the introductory comments, this clause applies to all entities except NBFCs. This is a significant scope enhancement. CARO 2016 required this commentary only for loans granted to parties under Section 189, whereas CARO 2020 talks about all loans. Second, it introduces the concept of advances in the nature of a loan. So let us suppose you have a supplier to whom you have paid an advance. The audit team will now come and check as to what is the amount of advance that was placed. Is it a reasonable amount of advance or is it really an advance which is in the nature of a loan? So if somebody gave 1 year's worth of purchases as an advance at the beginning of a year, this could potentially cause into question whether this advance is actually in the nature of a loan or not. So once again, an item which should be very carefully assessed both as management and as auditors. And finally, please do remember that if a loan is given and repaid in the same year, then that also needs to be assessed. Okay, so for those of you who are putting the questions on the chat box, my request is if you can also post the questions in the Q&A, just so that we don't miss out on those questions. So the first takeaway, enhancement in scope, item number 1 does not apply to NBFCs. Second, advances in the nature of loans are now covered, and loans given and repaid during the year are also considered. Another small nuanced point around this is that when you talk about loans to subsidiaries, associates, and joint ventures, the guidance note clarifies that the definition of subsidiaries, associates, and joint ventures is that under the Companies Act and not under the accounting standards. And you will recollect that the definition of subsidiary under Companies Act is slightly different from that under the accounting standards. So once again, something to be careful of at the time of reporting. These may not entirely agree with the RPT disclosures that you make in the financial statements. So like I said, the devil is in the detail. Some of these clauses are only going to be identified by looking at the guidance note in a lot more depth. With respect to comment around whether the loans are prejudicial in the interests of the company or not, again, as I said, this applies to all kinds of loans, all investments that the entity makes. It extends to investments as well. The guidance note has thankfully clarified that if you are evaluating loans, generally the key terms that one should evaluate will be the rate of interest, the security, the terms of the loan, the repayment conditions, if there are any other covenants, and the nature of the entity, and so on. So very important once again to keep in mind the context of the entity in which the loan is given. There are a couple of good examples that I would like to quote here. Let's say there is a concessional rate of interest that's given to a loan, that's given in a loan to a relative of the director. Now one could actually start evaluating that whether this concessional loan is prejudicial to the interest of the company or not. And at that point in time, one should therefore evaluate the context of this loan. That if employees are granted such concessional rate loans, and the person to whom this loan was granted is also an employee, then basically this is under the normal terms of the company. This loan is not prejudicial to the interest of the company. When evaluating investments, one should really evaluate whether the holding company has the ability and the power to make this investment. What is the financial standing of the investee company? What are the sources of the funding, the valuation, the covenants based on which the investment is made? Once again, very relevant to assess that the loan that is given is not prejudicial or harmful to the interests of the company. And there are situations that one comes across where a loan is given to a loss-making subsidiary that by itself, without assessment of any other facts, would not be considered to be prejudicial to the interests of the company. So fortunately, the guidance note does clarify that it's not that just because the entity is a loss-making entity and there is an investment made, it's prejudicial to the interests of the holding company. Because you do see holding subsidiary funding structures to be very commonplace even in genuine business conditions. So extremely judgmental clause, but some safeguards available is the takeaway we would like to highlight. And if there is a non-compliance with an applicable law, so for example, section 186 is not complied with, those loans could have a high probability of being considered as being prejudicial to the interests of the company. So if there's a breach with the applicable laws, please do look out the guidance in more detail, because you may end up with having those kind of loans as being prejudicial to the interests of the company. This is my favorite clause because this is something that is very close to the financial services entities. What a clause basically tells is, as an auditor, you are required to comment the regularity in payment of principal and interest where these terms are stipulated. Interestingly, regular is taken to mean that the principal and interest are received when they fall due. So if I have an EMI which is due on 15th of April and I pay that EMI on 16th of April, then technically I have not been regular in payment of principal and interest. And if that NBFC or bank has given me a loan, then the loan given to me is reportable. Extremely practically challenging for the financial services entities, and this really needs an industry-wide debate. Because if one looks at the guidance note, there is a suggested reporting format. That suggested reporting format actually requires the auditor to list out all the names of the parties. Now, to just give you an example, if a trade receivable does not pay on time, there is no reporting on CARO. But if you're an NBFC and in your ordinary course of business, you have given loan to a company and that borrower defaults by one day, that becomes a reportable matter. So I think on this clause, for companies, these kind of instances will be fewer. Reporting list of items may not be as challenging. But if you compare this to the NBFCs and the HFCs of the world, this could be an absolute nightmare to deal with. And one of the takeaways is that the guidance note may use the term suggested reporting format, but as an auditor, if I place myself in the shoes of an auditor, I would look at it more like a mandatory reporting. So again, if you have not picked this item up with your auditors, please do pick this up with the auditors, and if possible, take this to the industry forum and look for getting more guidance. There is still enough time before the CARO opinion becomes due, and that is why I started off by saying that the theme is a stitch in time saves 9. Another very typical example which will impact the NBFCs and the financial services entities is the aggregate amounts of loans that are overdue for more than 90 days and whether the management has taken reasonable steps for recovery are to be reported. A couple of matters emerge from this. First is it is not compulsory for clients to take legal action. So if you are a non-financial services company, or if you're a manufacturing company, services company, it is not necessary that a legal notice should have been sent to the borrower. You are required to look at what are the kind of steps that the company has taken for recovery. It could be the nature of follow-ups. It could be the extent of persuasion to receive money. Those are the kind of steps that you need to look at. If an amount is not overdue, management has not done anything at all, that is probably a reportable item. If you are an NBFC or a housing finance company, you will need to actually take the aggregate of all the loans which have a DPD of more than 90 days. And one word of caution is this amount would not agree or tally with the amounts that you report as stage 3 assets under the financial statements. Because stage 3 assets are also driven by other qualitative aspects and not just days past due. So if somebody had to look at the stage 3 disclosures versus CARO, there could be some differences. And that's the point I wanted to highlight with respect to reporting for 90 DPD loans. Right, this clause around evergreening of loans is not applicable to an NBFC or an HFC. That's partly because the RBI expects those auditors to perform procedures for evergreening. If you are auditing a non-NBFC or a non-financial services entity, the reporting requirement is that if there is a loan or an advance in the nature of a loan, which has fallen due during the year, and that has been renewed or extended, or a fresh loan has been granted to settle those overdue amounts to the same parties, then such renewal, such new loan granted becomes reportable under this clause. So let me take an example. Let us suppose at the beginning of the year, company A has an outstanding loan that it has given of 100 rupees. During the year, it grants 3 more loans of 200 rupees, 300 rupees, and 400 rupees. For 2 of these loans, which is the 100 rupees on the opening balance and 200 rupees that was given during the year, when they fell due, the company extended the term of those loans. Now, what is required to be reported under CARO is the auditor needs to state that 300 rupees of loans in aggregate were evergreen. And when it comes to the percentages, that 300 is that percentage is computed with respect to the fresh loans disbursed. So in my example, the 300 of loans that are extended is divided by the total loans disbursed during the year, which is 200 plus 300 plus 400. And that's how you report the 33%. One interesting point to be kept in mind is that if the renegotiation or extension happens after the balance sheet date but happens before the audit sign-off date, that is also to be considered for reporting. And the double whammy is that gets reported in the subsequent year's CARO reporting as well. So really, they're trying to take all possible precautions where nobody even evergreens a loan between the year end and the audit report date. Any renegotiation after the audit date, or rather after the year end, but before the date of the audit report, is also reportable, and it gets reported in the current year's CARO and the next year's CARO. So very interesting items that come out on the guidance note. The last clause with respect to loans and advances is if there is a loan or an advance which is repayable on demand, or the repayment terms have not been stipulated into, then the aggregate and the percentage of those loans to related parties and the promoter group are required to be disclosed. So the gating question here is there a loan that is given which is repayable on demand, or is there a loan that is given without any stipulation of repayment terms? In either of those two situations, if they are met, one would then give the percentage of such loans to related parties and to the promoter group. So fairly limited applicability, not a very largely applicable clause. And those are the key takeaways that we had with respect to loans and investments. Having covered the balance sheet side, let's now talk about some of the other clauses related to the governance side. Fortunately, fewer changes coming about in this one. We can quickly run through some of those changes and then take it further. When it came to compliance with laws and regulations, there were about 6 or 8 clauses that we thought we should pick it up with you. The first one was around reporting on whether the company has complied with section 185 and 186 of the Companies Act. If you recall, section 185 prohibits loans to companies in which directors are interested, and section 186 governs the granting of loans, guarantees, or providing securities to a person or any other body corporate. And it has restrictions around the layers of investments. Absolutely no change from CARO 2016 to CARO 2020. The same procedures that one would have expected to have performed in the old CARO will be continued to be performed in respect of 185 and 186. CARO 2016 also requires 2020 says that if there is a non-compliance with section 73 to 76 of the Companies Act, or non-compliance with the RBI directives for deposit acceptance, or with non-compliance of an order of the company law board, those are the non-compliances that need to be reported. What has only got added is that deemed deposits have been now specifically included to make the clause more tighter. But from a practical sense, we don't think this has a significant reporting implication for preparers as well as auditors. You would also recall that Companies Act section 148 requires certain companies that are engaged in the manufacturing or production or services to maintain records on utilization of material, labor, and other items of costs, which means they are required to maintain certain cost records. The auditor had to comment for those entities whether the cost records have been appropriately made and maintained. And that reporting requirement continues unchanged in CARO 2020. There were 2 more clauses in CARO 2016 dealing with statutory dues. The auditor was required to report on the regularity in payment of undisputed statutory dues, and if there were arrears of such dues for more than 6 months at the balance sheet date, those reporting requirements were triggered. Similarly, if there was a due which was dispute or which was not deposited on account of any dispute, that was also specifically required to be disclosed by the auditor. Once again, CARO 2020 does not change those reporting requirements. It only includes the GST to be one of the statutory dues. From a practical standpoint, even last year when the auditors would have audited this, they would have considered GST to be a statutory due, and that logic would continue even in the current period. So to summarize, with respect to these 4 items, no significant changes vis-a-vis CARO 2016. If I move on and pick up some of the 4 other items to talk about, compliance with section 177 and 188, these dealt with related party transactions. Section 177 dealt with the audit committee approvals, and section 188 dealt with the process of approval of transactions not in the ordinary course of business and not at arm's length. The CARO requirements in 2016 and 2018 has remained as it is, no significant changes. If there is non-compliance, please report. If the disclosure requirements of the accounting standards have not been met with, please disclose. And same way with compliance under section 192. Section 192 dealt with non-cash transactions with directors or persons connected with directors. Once again, the evaluation of whether such transactions have happened, and if they have happened, whether they were or whether the approvals were sought in compliance with Companies Act 2013 is what the auditor needs to report. So once again, no change in the reporting requirement with respect to this clause. There was one reporting requirement with respect to compliance with 197 and Schedule 5 for managerial remuneration. That reporting requirement has been taken off from CARO. Auditors used to report on this in the primary audit report as well as CARO. The CARO requirement has now been dropped. Finally, one new clause that has been introduced, and this is an interesting clause, is reporting of unrecorded income in the financial statements that was surrendered or disclosed in the tax assessments. Now, this is a new reporting requirement. What this reporting requirement suggests is this clause is applicable only when the transactions are not recorded in the books of accounts and have been surrendered or disclosed as income in the respective year's tax assessments or in the tax assessment. What undisclosed income means or includes is the Income Tax Act 1961 provides guidance around this. It includes money, bullion, jewelry, any documents, any goods as undisclosed income, which are then considered or deemed to be income or assessed as incomes. Similarly, if there are allowances or deductions that were claimed, which were not approved and had to be added back or had to be disallowed, those could also be considered to be reportable. But the emphasis here on this reporting is surrendered or disclosed, which means only if this is something that the company has done voluntarily does the disclosure requirement trigger. If the company has disputed the department's contention, has disputed this claim, the auditor will not be required to report under CARO. So that is what we had to talk about in terms of the governance or the compliance related aspects. One change that is meaningful is around the unrecorded incomes. No other significant changes for management and for auditors. For this one, the key item would be looking at the income tax assessments and seeing if there is any item which relates to assets specifically, which is then accepted or voluntarily offered for tax as income. For this part, we had covered the first 3 themes. In the next part, we will talk about some of the audit related aspects and what it means for the auditor, uh, what it needs for the auditor. Uh, that is what we wanted to cover in today's session. If you have any questions, please feel free to write to us. I will look at the questions that we have here and see if we can address them today. There are three questions that I can see in the question box. If there are no adverse comments in the CARO report of a subsidiary, then whether CARO will still be attached to the main audit report. And I think here the answer is that this reporting is only if there is an adverse report either in the holding company's own CARO or in the subsidiary's CARO. My personal view is that you may not need a CARO opinion in the consolidated financial statements, but I can look at the guidance note once again and come back to you when we meet next. With the other question that I can see is, should the auditor judge loans given only from the economic benefit it obtains? That is, whether the interest levied is at arm's length, even if it's lower than the cost of funds. What about situation where the company has lent some at a reasonable sum but couldn't find to repay its obligations? Would they be considered to be prejudicial? This is definitely a situation that would call for an assessment of whether it's prejudicial or not. One of the key things that one would look at is, generally you would not lend money at a rate that is lower than your own cost of funds. So that could be a very strong case of evaluation for whether it is prejudicial to the interests or not. But that alone, in my view, would not be conclusive. So just because it's lower than cost of funds does not make it automatically to be prejudicial to the interests of the company. One should really look at the nature of the loan, the reason why this transaction was given in such conditions or in such reasons. Okay, the last question is around evergreening. It's not clear as to how an evergreening loan gets reported twice. Well, I think it's a fair question. What the guidance note talks about, and this is a directly interpretation that is there in the ICAI guidance note. It says if there was a loan that was evergreen or that was rolled forward after 31st of March, but before the balance sheet date, that has to be specifically reported. So now the situation is that the guidance note states that subsequent event needs to be reported. So that's the exception for the year of audit, where although the roll forward did not happen before 31st of March, the reporting gets triggered. If you go to the subsequent year, that is the year when the roll forward has happened and when it was anyway due for reporting. So yes, it is a bit of an anomaly, but this is quite clear in the guidance note in terms of the requirements. So that's all that we had for this part. Thank you very much for taking out the time, for your patient listening. Look forward to seeing you same time next week, where we will cover the other two parts. In the interim, if you need any help on implementation with respect to CARO, if you have questions that we have not addressed in today's session, please feel free to write to any of us. We'll be more than happy to write back to you. As we said, this is a knowledge sharing platform. We only learn when we interact with you. Thank you once again. Have a very good evening and have a very good weekend. Thank you.